Good evening, everyone, and welcome back to the channel. I hope you've had a wonderful weekend and that you are doing well and staying healthy. It is that time to get ready for the week ahead. So let's go ahead and do that, shall we? The Nasdaq rose 25% in April and May combined. That is the best 2-month stretch since October, November of 2002, 20 years. The S&P 500 closed Friday at a 9th consecutive weekly gain. Every major index ended the month at all-time highs. We had phenomenal gains by Dell, beat by almost $2 per share and $8 billion on revenue. 90% of the S&P 500 companies beat earnings estimates. Quarter one earnings growth has come in at 28.6% year over year, and that is the best since 2021. So now what? Here's my honest answer. The easy part is over. The earnings tailwind that has carried April and May is practically gone. We do have Broadcom reporting on Wednesday, and that is the last major AI earnings print until Q2 season kicks off in July. So between now and then, the market has to stand on macro data, geopolitical headlines, and its own momentum. Two of those three are currently working against it. Let's jump into the charts. This is your SPY daily chart. SPY closed on Friday at 756.48. Prices above the 21 EMA, the 50 SMA, and the 200 SMA on every time frame. The weekly and the daily both read max bull readings. There are no current squeezes on the board. Momentum is well above the signal lines, and we have an ultimate bullish trend of higher highs and higher lows. We did get a little bit of a stall on the hourly chart at the recent high. That is not a reason to panic, but it's just the map. Any news that cracks the Iran peace story could produce a 1 to 2% pullback relatively quickly. However, the structure should survive it. Your account might not if you're overexposed. What I mean by that is if you are buying up here at the highs, you need to have a defined stop loss and protect your risk. Because if we come back to the daily chart, we can clearly see the overall trend is bullish, but we have yet to retest the mean. We have not reverted back to the mean. So if you are buying here at the highs, you are going to really need to anticipate possible downside exposure all the way down to the 21 EMA, which resides at 737. If we turn our attention to the Q weekly chart, the Nasdaq closed at 738.31 at the end of the week. It is the same condition as SPY. We have a max bull reading on the weekly and the daily, with momentum in the upper extreme on both time frames. That is an overbought condition. Overbought is not the same as topping, but the easy money from the April lows is pretty much behind us. The good news is that the Dow has also joined the all-time high party. We can see that we are in a uptrend here on the daily with higher highs and higher lows, and we just broke out into recent new all-time highs. We have a max bull reading. The squeeze condition has started to trigger to the upside. Momentum is bullish. We can see that the 50 simple moving average here is curling higher, as well as the 200. So this chart is very constructive. Small caps did take a little bit of a breather on Friday looking at the IWM daily. The IWM on Friday closed at 290.43. The weekly and the daily are both showing max bull readings. The hourly, as you may have guessed it, closed up at neutral up at 65%, with thrust not aligned. However, small caps did participate in May and is up nearly 17% since the end of March. But the short-term structure is a little bit choppier than the large cap indices. The weekly and the daily give you the green light, but the hourly is just not confirming in the same way that we've seen in the other indexes. So what drove the rally and why that changes? First of all, we have Dell up 30% off of its earnings report. Dell reported $43.8 billion in Q1 revenue, which absolutely destroyed the $35.7 billion estimate. Snowflake at a 37% gap from Thursday. Snowflake's beat and raise woke up the software space. This allowed the IGV the software ETF to break above its 200-day moving average for the first time this year, and that's what built the final leg of May's run. The AI build-out is strong and earnings proved it, but earnings season is now over and behind us, so the market has to find something else to stand on. And the answer is really three things. We have Broadcom earnings on Wednesday, jobs on Friday, and not to sound like a broken record, but the Iran deal either getting formally signed or just falling apart, and that's the whole week. I know it sounds like a broken record on the whole Iran situation, but it is something that you need to have in the back of your mind regardless. If Broadcom delivers the way that Dell did, the AI trade could get another leg and the semiconductors holds its structure. If Broadcom, however, guides soft, that whole AI momentum story could get its first real crack since the April low. Either way, we're going to learn something. The jobs report on Friday, we're expecting 85,000 to 105,000 added, with unemployment at 4.3%. A print above 150,000 is kind of the danger zone. PCE hit 3.8% in April, so a hot jobs number layered on top of that forces the bond market to essentially price in a rate hike, and equities are going to follow those yields. Now let's talk about the semiconductor ETF. Closed at 598.93 on Friday. The weekly momentum is at 89.2 with a bull slingshot. We got thrust alignment, very extreme reading. The daily oscillator here is at 83.8. The Philadelphia Semiconductor Index, the SOX-L, is up roughly 80% since the March low, and honestly, that's the cleanest chart in the market right now. I do want to watch the 581 mark as the first level that matters below price, so a soft Broadcom print could possibly test that 581 level. If we go back to the IGV, it's at 101.66 with a max bull it's neutral up here on the daily at 70%, but the weekly still has some form of structural damage. It's still showing as neutral, but the above the daily 200 simple moving average is probably the biggest software development this past week. Traders who got hurt in software in Q1 are just now starting to come back to life, so it's definitely something worth watching. Now, I will be straight with you. This is the HYG weekly. This is your junk bond ETF. The HYG is at 80.31. It's right on that line that, I've been all year. But as you can see, the weekly structure score here is still in bear territory with a minus 80%. We have no trend here. And one of the key things here with the HYG is that you want to look for trend. You want it to confirm equities moving higher, and we just don't have that right now with the junk bond. So the weekly is telling a different story here, and that credit is not confirming this equity rally. All-time highs in stocks, great. HYG is just barely clinging on, and we just don't have any sort of positive trend, and that divergence is most likely not going to resolve quietly. It's just a matter of when at this point. If we look at the TLT, we can see that we've had a nice bounce over these past 2 weeks. The weekly chart is still neutral with no trend. The long bond is possibly in trouble. The hourly is showing that short-term bullishness here that you can see on the chart. Bull 80%. You are trading above the key moving averages with that 200. Still declining, but it may flatten out within the next day or two. But when you put the 2 and 2 together between the hourly, the daily, and the weekly, bonds are definitely a little bit of a headwind right now, and it's not much of a safe haven. If we turn our attention to the 10-year yield, it closed at around 4.45%. It's now trading at 4.6% during the overnight session. The 30-year hit 5.2% before pulling back to slightly below 5%. The 2-year is sitting at 4%, and that's exactly where it sits when the bond market thinks that the Fed should raise rates by 25 basis points. If you only remember one thing from this video, just remember the HYG chart. A weekly close below 80 while equity sit at all-time highs is a clear warning sign within the setups. Now let's talk a little bit about the macro situation. This is your PCE chart. It hit 3.8% in April, which is a 3-year high. Core PCE came in at 3.3%, which was also a 3-year high. Personal savings dropped to 2.6%, and incomes have stagnated. A ceasefire extension with Iran was reportedly agreed to this week, which knocked oil down like 10% and yields lower, and that's the fuel that finished May out. but the deal still hasn't been formally signed. Trump still needs to approve it. Iran has its own conditions. And I think this evening, the current Iran president is seeking to step down. So there's still a whole lot of questions to be had. Even if it does hold, Deutsche Bank said the rate hike risk doesn't just disappear. We need to see oil fall back below its pre-war levels, which would drop us back below like 70. And right now we just don't have that. Futures markets are pricing a higher probability of a rate hike this year rather than a cut. We have Kevin Warsh's first Fed meeting June 16th through the 17th. He came in expecting to cut rates, and he just might not have that option. If we continue to look at the macro data, we can see the dollar is trading at about 99. It's still below the 100 level, which is great. We are in a neutral trend here, and that is a tailwind for equities, and it is a tailwind for emerging markets, but we do want to continue to monitor the dollar in case it does strengthen or weaken. Moving on to the VIX is at 1532. It still has possible legs lower to visit the 14 and 13 area. It's max bear on the hourly. Complacency is high, consistent with a market grinding higher, also consistent with a market not pricing in much risk at all. Now let's talk about sectors. There are two sectors, three really, that are carrying this index. It is tech and semiconductors. We could argue financials, but to me that's still a bit generous because financials are nowhere near all-time highs. Looking at the XLK, it is at 191.02. Big bullish move off of the end of March lows. This is definitely the engine, and it's clean cut on every single time frame. You know, even if that's the XLF, there's still a stark contrast here. We're holding somewhat structure here, but it is very neutral across the board. We do have a daily squeeze, and only 2 of the 11 sectors are at record highs, while the indices itself are at records, and Rosenberg Research flagged it this week, and pretty much the charts confirm it. So, you know, financials for me, I'm wanting to do something here, 52.60, get back over the daily 200 simple moving average. So when I said that 2 sectors are carrying this index, it's really just tech and semiconductors. Financials are nowhere really close to carrying that weight, to be honest with you. Regional banks, though, they're doing pretty interesting. They're at 69.60, trading above all of its key averages. We're still just looking for a break above that 71 threshold level. The regionals are definitely watching yields, not leading just yet, but there could be an opportunity here. The rest of the sectors are pretty much damaged. XLE took a direct hit from the Iran ceasefire trade, minus 60% on the daily. Even though it's maxable on the weekly, this is still pretty damaged. We're below the 21 EMA, below the 50. We are hitting the 382 retracement level, which is slightly higher than where we bounced at the 50% retracement level. But for now, it's definitely a little bit of a tricky spot. But if deals drastically fall apart, the XLE has the potential to bounce hard. So when looking at the sectors, honestly, tech is doing all the real work. Everything else is either waiting or selling off. So what are we watching this week? Well, we have tons of stuff on the economic calendar, starting on Monday with the ISM manufacturing PMI. We also have Jensen Huang keynoting the NVIDIA GTC in Taipei at 11 a.m. Taipei time. Any AI infrastructure announcement from Wang is going to move semiconductors. On Wednesday, we of course have Broadcom earnings, and this is the week's defining event. If Broadcom Dell did, the AI trade is going to get another leg. If it guides soft, you'll definitely feel it in the SMH and the XLK pretty much immediately. Also, ISM Services PMI, and we have the Fed Beige Book on Wednesday. And then closing out the week on Friday, June 5th, we have the non-farm payrolls. Consensus is 85,000 to 105,000 jobs. Unemployment at 4.3%. A print above 150,000. Pairing that with 3.8 PCE is going to give the Fed reason to move. The bond market would start to price it in before the equities do. As far as SPY levels go, I'm watching the 21 EMA, which sits at 737. I believe 700 is also a pretty logical and psychological level to continue to keep an eye on if we do break down further. There could also be some in-between areas of support like around 725. And then for the Nasdaq, of course, watching the 21 EMA, there's this level here at about 722 where it would gap fill and also retest the prior all-time high breakout. We could also see that psychological 700 level on the QQQ as well. But below all this, there's a lot of wiggle room to push further down if we get a deeper pullback. Of course, I'm watching the HYG, paying attention to that 80 level, see if we start to trend in either direction. I'm paying attention to oil. I'm watching the 10-year yield, which is at 4.45% right now. A push back above 4.7 and especially above 5% is going to hit rate-sensitive sectors first. Broadcom on Wednesday is definitely the one to circle along with all the economic data. The AI earnings cycle is either going to get a clean finish or it's going to get a little bit of a stumble. Either answer is going to tell us something about how the next 6 weeks are going to shape up. I have the full written version of this discussion with charts, levels, my monthly scorecard on what I got right and what I got wrong in May. That is all in my Substack. The link is in the description. If this was useful, please hit that like and subscribe, and I will see you tomorrow for the daily. Take care, guys. Have a great rest of your evening.